Hi, this lecture is going to show the closing process. In chapters 1 and 2, you learned how to make journal entries. In chapter 3, you learned about adjusting entries. In chapter 4, we're going to continue practicing adjusting entries, and then finish out the accounting cycle with the closing entries, and then also the post-closing trial balance. So what does the closing process mean? What this means is at the end of the period, we need to get our books ready for the next period. It's the same as a scoreboard for a football game or any game where when the clock is at the end of the game, it resets for the next game at 0. So we have to do this for certain accounts in accounting. So the accounts that need to start back at 0 so we can find out how much we make for the next period are going to be your revenue accounts, your expense accounts, and your owner's drawing. The other accounts won't start back over because they're balance accounts, and it would make no sense to put cash back to 0 or accounts receivable back to 0, because you still have the same amount of cash in the bank even at the beginning of the next month or the next period. And whoever owes you money for accounts receivable still owes you money. So the only accounts that we need to close are going to be your revenue, your expense, and your drawing. So the closing process says close revenues to income summary. Income summary is just a very temporary account that we are just going to use during the closing process. Then we're going to close expenses to income summary. Then we're going to take this very temporary account income summary and we're going to close it to capital. Because capital holds all the accumulations of net incomes and losses for the entire period, or another way to say it is it holds the net income and losses for the entire company's life. And then we're going to close drawing to capital. And the reason that we close drawing straight to capital is because income summary is just going to temporarily hold revenues and expenses and close that to capital. And then we're just going to close drawing straight to capital. So everything ends up in capital, all of these accounts. And really the easiest way to see this is by looking at an example. So this will be done at the end of the period, which we'll pretend that our year ends December 31st. First thing I'm going to do is close revenues to income summary. So I look for my revenue account, and my revenue account is called fees earned. Fees earned is revenue, and it has a normal credit balance. So if I want to close an account with a normal credit balance, if I want to close it, that means when I say close it, I mean get the account to 0. I need to do the opposite to it, so I need to debit fees earned for the amount of $380,450. So let's do that. Alright, step 1 also says close revenues to income summary. What that means is I'm going to put my balance, transfer my balance to income summary. So step 1 is done. I have transferred my balance of fees earned of revenue into income summary. Now step 2 says to close expenses to income summary, so I need to go down and look at expenses, and I have 3 different expenses. And remember, the normal balance of an expense account is a debit, so if I want to make these accounts 0, I would need to credit these accounts. And since I will credit these to close them, and I'm closing them to income summary, my debit will be to income summary. So it will be for the total, so I need to go ahead and do all of my credits first so I can get the total for the income summary. So we know we're going to have wages expense of $250,000 and rent expense of let's see, $65,000, and then supplies expense of $24,450. So my debit would be the sum of these three numbers, which is $924,450. Correction here, this I have too many zeros on this, so let me fix that. 65,000, and now this is the right number, 339,450. So that completes step number 2, close expenses to income summary. Here are my expenses right here, and I close them to income summary. So step 2 is complete. That means that the balance of fees earned is now 0, and all of my expense balances are 0, meaning they have been closed out. Now I'm on step number 3. Step number 3 says close income summary to capital. So in order to figure out how to close income summary, I need to see what the balance is in income summary first. So let's use the T account for income summary. We know up here that we had a credit to income summary of $380,450. And then in step number 2, I debited income summary for $339,450. This top number represented revenue and this bottom number represented expenses. So basically I have revenue minus expenses, so really I'm holding net income. I'm holding net income in income summary, which makes sense because it's the summary of my income. So which side is bigger? The credit side is bigger, so it appears that my balance is going to be on the credit side. So I take my credits minus my debits, and income summary has a balance of $41,000. Now that I know that income summary has a credit balance of $41,000, I am ready to complete step 3, which is close income summary to capital. Found that we have a credit balance in income summary, so if we want to get this balance down to 0, we would have to do the opposite and debit it for $41,000. So I'm going to debit for step 3, I'm going to debit income summary for $41,000. And it says in step 3 to close it to capital, so I'm going to credit capital for $41,000 because I'm closing it to capital. Alright, let's stop and make sure that this is making sense. Let's think about what happened. We are putting net income into capital. And a credit increases capital, so net income is making our capital go up. And that is exactly what it should do. Net income should make capital go up. Just as you've done on the statement of owner's equity when you've added net income to capital, here we're actually doing it in the accounting records to get it ready for next period. And I keep adding zeros in there. So make sure that you see that this is $41,000. Alright, let's look at step number 4 now. It says to close drawing to capital. So here is my drawing account, $25,000 in drawing. Remember that drawing has a normal debit balance. So to close it, I need to credit it. And the other side, this time it says to close it to capital. So I'm going to debit capital for the amount of the drawing, $25,000. And I am going to credit drawing for $25,000. Now, does this transaction make sense? Does this journal entry make sense? I debited capital, which makes capital go down. Does drawing make capital go down? It does. Net income makes capital go up. Drawing makes capital go down because the owner has withdrawn cash from the business, so this makes capital go down. So this completes my 4 closing entries. So now, as always, I need to post these. So the first one is fees earned. So I find my fees earned account, and here it is. And it's coming from journal entry 1, and it was a debit of, I believe, $380,450. Now, if I had a credit balance of $380,450 and then I just debited it in the closing entry, then I would have a balance of 0 in fees earned. This is exactly what I wanted to happen. I wanted to have the balance to 0 so I can start over in the next period. I'll place that into the account 40. So I will go up here and put 40, and now fees earned is done. So now I will do income summary. Income summary, if I can find it. It's down here. So it was the first entry, and it was for a credit of $380,450. So right now it has a credit of $380,450. Sorry, $380,450. And then I can go back up. This is account number 32. I can go back up to my journal entry and write 32. Here I debited income summary for $339,450. So I will go back down to income summary, and I will, this is journal entry number 2, and I will debit it for $339,450, and then my balance would be credit minus my debit. So now I have a credit balance of $41,000. And of course, this is account number 32. I posted it, so I go back up to my journal entry and post it into account number 32 to show that I posted it. Wages expense is $250,000, so I would go down to wages expense, and this is journal entry number 2, and I credited wages expense for $250,000. So now it has a balance of 0, and I can go back up. This is wages expenses account number 51. So I would post that 51, and now I'll do rent expense, $65,000. So go down to rent expense, and I credited rent expense for $65,000. And this was journal entry number 2, and it had a debit balance, and then I just credited it, so now there is a 0 balance in rent expense. And then you would continue to do this for each account and write your post reference down for each account. I will do an additional video to show the rest of this problem.